Our next guest was recently crowned top base metals forecaster for another year by Metals Bulletin. Edward Meir joins us now. He's a commodity consultant and the president of his own firm. Edward, thank you so much for joining us today on Kitco's Gold Report.
Thank you for having me.
So let's look at your calls for the precious metals this year. I know you recently revised your gold forecast given the rally we've seen. Let's talk about your forecast for both gold and silver.
Okay. First of all, with gold, we were, like most people, quite bearish going into 2016, late last year. However, we've changed our outlook considerably over the last few weeks, given the turmoil we're seeing in the equity markets. I think this correction is quite serious. I think there is a lot of uncertainty with regard to the staying power of these rallies that used to sort of stick before, no longer seems to be the case right now. So I think equity markets are going to be in for a rough year, which by definition, or theoretically I should say, should bode well for gold prices.
So the range for gold you have is now between 1045 and 1310, correct?
Correct, yes. And the bias, I think, would be more to the upside as opposed to the downside. So in other words, 1350 is also possible. I think it all depends really on where you think global equity markets, particularly U.S. equities, will be, how they will be faring this year. If you think there'll be more of a correction, which is what I think will be the case, gold should do better. And of course, recently, all this concern about the European banks and increasing debt levels and all that is just helping drive the rally even further.
So have you also revised your silver forecast? What range are you looking for here?
Silver is going to proportionately move up as well. I think I would say a $13 to about a $16.50 range on silver. It will probably look reasonable to us.
So Edward, obviously a big factor that affects the gold price is obviously the US dollar. The metal has had quite a good run as the greenback struggled. And you say the dollar sell-off may not be over. How high could you see gold prices go from here?
Well, like we talked about previously, I think the upside target for gold could be anywhere between 1310 to 1350. We think the dollar will likely trade sideways to a bit lower over the course of 2016. We say that in view of the fact that the Federal Reserve will likely not raise rates more than once this year, maybe twice, but I think it's really once more, and that'll be it. I think they've really painted themselves into a corner in that they cannot raise rates without inflicting what could be potentially large damage to borrowing and to the economy. So we are in this paradigm of bumping along zero rates pretty much globally for years on end. I really don't know how these central banks are going to emerge out of all this and raise rates to normal levels. And I think at least as far as 2016 is concerned, that should be a tailwind for gold as well going forward.
Finally, Edward, you've retained your crown for another year on Metal Bulletin's base metals price predictions. Let's talk briefly about how you see the base metal setup here.
Sure. Base metals is a completely different animal. It's very much a China play. You know, China consumes 50 to 80% of all these metals that we cover. And given that their economy there is really in deep trouble, particularly on the manufacturing side, we think that base metals will likely struggle from here. We think we could retest the lows over 2016. These are the 2015 lows we're talking about. You know, we're seeing some move up right now in the group as a whole, but that's more currency related as opposed to any fundamental factors. And what needs to happen in base metals, similar to steel and oil, is suppliers need to cut back production, and they're just not cutting back production fast enough to move the needle.
Edward, thank you so much for your thoughts today.
You're most welcome. Talk to you soon.
And thanks for watching this edition of Kitco's Gold Report. We'll see you tomorrow.